So guys, welcome back to this channel. This is Go Digits Forex Academy, and in this video I'll be teaching you guys how to take sniper and A plus setup using liquidity and fair value gap, right? I'll be using just fair value gap and liquidity area to teach you this sniper entry. This strategy can be used on higher time frame. You can even use it for multi-time frame and the likes, and I'm going to show you how it exactly works. So whether you're a beginner, you're an intermediate trader, or a professional trader, this video is actually for you. So pay attention, guys. So firstly, what do we understand by FVG, which is the fair value gap, right? As you can see in this note, you can take a screenshot of this so you can get back to it later. A fair value gap right there. A fair value gap is an imbalance in a price caused by aggressive buying or selling, where the market moves so quickly that it leaves a gap between candles, typically a three candle structure. So it represents inefficiency pricing. Price often return to this zone to rebalance liquidity, act as a high probability area for continuation trades when aligned with the trend. Do you understand what that means? Now, when there is high volume in the market, high momentum in the market, or let me say displacement in the market, right? We tend to have a fair value gap. A fair value gap is that gap in between three consecutive candles. So when you see three consecutive candles forming the structure, the one at the middle shows the gap between them. Do you understand what I'm saying? Shows the gap in between them. And as you can see in this drawing right here, look at it. Let's assume these are the three consecutive candle. This one at the middle here is the FVG. Right. Let me move it to the left. So you can see this is the FVG right here. So this zone at the middle here is the fair value gap area. Do you understand that concept? It's just an area where by it shows that there is momentum in the market. So when you have a bullish trend, right? You have a bullish trend, or in the overall trend, right? You have bullish. Then on your smaller time frame, get to spot an FAG. You don't just jump on that trade. You wait for confirmations to give you A plus entry, like A plus entry. Now, moving on, we have what is called the liquidity concept. Now, liquidity refers to areas where orders have clustered, especially above the high and below the lows. So liquidity forming above the high is known as the buy side liquidity, and liquidity forming below the lows is known as the sell side liquidity. Do you get what I'm saying? So the liquidity forming at the high of a trend is called buy side liquidity, and the swing low, right, is called the sell side liquidity. Now, market makers or institutional traders, right, often target these zones to trigger stop losses and fill in large orders. This is commonly referred to as liquidity sweep or grab. Now, liquidity area functions in these two ways. Number one, liquidity areas are usually areas where retail traders love to put in their stop loss, and by so doing, they are accumulating orders. At the same time, this liquidity area also serve as target for institutional traders. So let's say, for example, we've been bullish and price wants to reverse. Price will have to take out uh, buy side liquidity, targeting the sell side liquidity. So liquidity generally serves as a fuel that moves price from a level to another level. So price doesn't just move randomly, it moves as a result of liquidity. It serves as a fuel. Now, for this strategy, this is the bearish setup. The first thing you want to look for is to identify the overall trend of the market. You want to trade according to the overall trend, right, of the market. So secondly, you want to spot a bearish FEG in line with the trend. So if the trend is bearish and you spot a bearish fair value gap, majorly I would suggest that you can also wait for fair value gap forming in the London session or in the New York session. These are high volatile market sessions. So please pay attention to that. We also have the third confirmation that wait for a liquidity to form below the FEG. That is, it has to form below the FEG, not above the FEG. It has to form below the FEG. And what's the next confirmation? Price often retrace upward, taking the liquidity above the FVG, which serves as stop hunt, right? They enter a sell as the price reacts from the FVG zone, targets a 1 to 1 or 1 to 3 risk to reward ratio. This is for the bearish scenario, and this is for the bullish scenario. The same thing applies to this. Now let's look at this particular trend right here. This is the example of a bullish scenario. Let's say we already have um, a demand zone that formed all the way that right here, right? Let's say we have a demand zone right here, and price retraced into that demand zone and gave us a fair value gap, which is, and let's say we have a bearish trend, right? The overall trend is bullish. Let's say the overall trend is bullish, right? Price broke structure and price retest. After that retest, price gave us an FAG. And after what? Price formed a liquidity level, which is the next step. We say wait for liquidity to form above the FVG. Now this is the fair value gap right here. And you can see the liquidity formed above this FVG right here, which is this liquidity. Right? Price pushed up to the upside, giving us a break of structure, right? You could see this as a BOS. So you can say that this formed as a BOS, and afterwards, what the price did? Price rallied down to take out this liquidity. Remember, we still have an FEG here. So for this kind of trade, this is this an opportunity to take a buy. So you would have taken a buy just like this. You want to go long and take your buy after the close of that particular candle and target a 1 to 2 or a 1 to 3 risk to reward ratio. Do you get what I'm saying? And your stop loss will be just below that candle wick for your stop loss, and you are good to go to ride this particular trend. So this is just the basic simple concept, and with this you can actually still find this same type of price action in higher time frame, not just on 5 minute time frame. Now how do you multi time frame this particular strategy? Now look at this. For the multi time frame application, it says use higher time frame HTF. That is your 30 minutes or your 1 hour, depends on the one you want to use. Using higher time frame helps you to get maximum entry position, like a larger RR, risk to reward ratio, when you use higher time frame conference. So to identify the FEG and the trend, drop down to a lower time frame, that's 5 minutes or 15 minutes, for a liquidity sweep confirmation. Precise entry execution, that's so sniper. Then example, this is just a brief example. So look at this, study this. You can take a screenshot of all of this that I've just mentioned. Then let's go deep into the video. Let's look at rechart after all of that has been said. Now look at this particular trade right here. Look at this. We had a fair value gap right here. Remember, price moving bearish, right? Don't forget, we've been bearish for some time. Price was dipping for some time, and we got a fair value gap right here. And above, this is just a small example, right? It's just a basic 101 example. Look at this. We got this fair value gap right here. Price gave us liquidity above this FVG. What the price did? Price took out that liquidity right here. This was as a result of news, right? It's as a result of news. Now let's look out for other example. Look at this. See that we've been bullish all the way here. Look at this particular one as well. Fair value gap, liquidity resting above that fair value gap. Price took out that liquidity right there and pushed upward, right? Now let's look at this example. You can see price was reversing at this point and gave us a beautiful FEG right here. And afterward, price gave us a liquidity area. Price reversed to the upside. Look at this break of structure right here. Look at that. If you scale on smaller time frame like a 1 minute, you would have seen that break of structure even much more visible. Can you see this particular break of structure that happened right here? Can you see, guys? We got this beautiful break of structure that helps us to confirm our buyers break of structure. Look at liquidity resting at this point, right? As you can see, price took out the liquidity here. This is a perfect entry model. Then this is how you'd have taken this entry at the close of this bullish candle. Where will your stop loss be? Your stop loss will be just at the wick of that liquidity, right? That this will be where your stop loss is. 1 to 3 weeks to reward ratio minimum. 1 to 2 or 1 to 3. Look at this beautiful entry. Let's look at for more example. Look at this particular trade right here. Price has been dipping. Can you see? We have price dip down. Now we want to take our entry. Look at this fair value gap, liquidity resting above the fair value gap. Now let's play price forward and see. You can see price swept liquidity just as predicted. Can you see, guys? This is an FVG area. And look at this liquidity. This liquidity resting right here. What the price did afterwards? Price came to take out liquidity and push to the downside. Can you see? So if you had want to take your trade, this is exactly how you would have want to take your trade. Your stop loss just above the FVG area and target 1 to 3 weeks reward ratio or more. And boom, look at that particular entry. So let's see if we can get another example that we can work with. Okay, look at this particular example right here. Look at we have a demand zone around the zone here. Price give us an FVG right here. This is the fair value gap the price gave us, right? This is the fair value gap that price gave us. And afterwards, we have liquidity resting above that zone. Right, look at this beautiful liquidity area resting above this FVG. Please pay attention, guys. You could see this is FVG that formed liquidity came in play, and what happened? Price retraced back to sweep that liquidity, right? Price retraced back to sweep the liquidity that was formed at this point. Can you see, guys? So this is a perfect entry. Wait for a bullish candlestick to close above that zone, and you are taking your long position just like this. Your stop loss will be right below that liquidity candle, which is this. Can you see? That is where your stop loss will be. Your entry will be after the close of the bullish candlestick, right? And target a 1 to 3 restore ratio. Boom. Look at that beautiful trade. FEG, liquidity resting, sweep of that liquidity and continuation. So one of the best way to trade is don't just be trying to catch reversal all the time. You can as well trade alongside with the trend, right? Can as well trade alongside with the trend. Look at this particular one as well. This works. This strategy is so simple. Identify the FEG. This is step one. Identify liquidity resting above below the FEG. This is step two. Can you see, guys? This is not just me trying to make things up. This is what the market is telling us to do, right? And price retraced back into that liquidity that is resting above the FEG. That is our confirmation. And this is how exactly we are going to take our trade. You go short at this point right here. Or let's say, okay, after price takes our liquidity, look for bearish candlestick to close. Look at this. Your stop loss just at that liquidity swing, right? Just at that liquidity swing, and this your entry will be at the bearish candlestick that closed below that. That is a 1 to 3 weeks to order ratio. So as you can see, guys, more examples like this. This happens almost every time in the market, almost every time. Simple strategy. You don't need any indicator to master this strategy. It's as basic as this. There's no any further grammar to that. If we check other assets, you see that I have been trading this strategy as well, and it works perfectly well. Like it works like magic, guys. It works like magic. Look at this particular trade. Look at this particular setup. Come here, let me try to zoom out. Now look at this high that was formed. Liquidity, fair value gap formed. Liquidity resting at this zone, but should be below the zone. But look at this. Price took out liquidity that is resting here. Look at this liquidity. Price took out that liquidity. You want to take your trade after the bearish close, right? After the bearish candlestick has closed, which is this. Pay attention, guys, and your stop loss just at that week. I'll target a 1 to 3 weeks to reward ratio. Let's see if we get that. Boom! Look at that massive drop. FVG confirmed, liquidity taken as well, and we dumped without much retracement. So guys, it is as basic as that. Look at this particular opportunity as well. You can keep on scalping. Imagine if you see this particular opportunity happening like twice in a day. That's a very good win rate. Look at this particular trade. FVG confirmed. We got liquidity resting here at the swing low. We can use this either of these two. So let's just take this because of the candlestick formation. Look at that. Price retraced back to take out that liquidity and boom to the upside. 1 to 3 weeks to order show. Let's see if we're going to get that as well in this particular setup. You want to go long after the close of that bullish candlestick, your stop loss just at the week that swept the liquidity. This is where your stop loss will be, and you want to target a 1 to 3 risk to reward. Look at this 1 to 3 risk to reward ratio. Boom, like 1 to 3, always 1 to 3. Look at that. So we've done so many examples. Just follow the basic step. This step one is to find an FEG. Step two, make sure that you find a liquidity resting above this FEG. That's step two. Step three, wait for price to take out that liquidity resting above the FEG. Once you see that price has taken out that liquidity, look for candlestick close that is in line with the trend. Look at this. We are expecting bullishness, right? Price took out liquidity and we had bullish candlestick. So this is a perfect way to take the entry. Perfect way to take the entry. And you can see after price hit the TP, price gave us another FEG, gave us liquidity area. Price swept liquidity area and we tanked straight down into the sell side area. So this any liquidity resting above here is called the buy side liquidity. The one resting below is called the sell side liquidity. So that is what the strategy is about. I want you guys to practice and backtest this particular strategy and show me screenshots of your win rates.